Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to the results that may be obtained from this. Investing involves risk, including loss of principal, and no strategy assures success or protects against loss. Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Hello, welcome to Vantage Point with True North Wealth Partners. Today is September 21st, Wednesday. Fed conversation day.
Ding, ding.
Yeah, it was
AKA,
a big day.
Yeah.
That's right. And here we are. Glad to be with you. I'm Eric Biddle.
I'm Eric Susi, episode 27. Can you believe it?
Yeah, unbelievable.
Jeez.
Yeah.
Going good.
Yeah, that's right. This is my first one to help you host. I was on one other one with you,
true.
but this is the first one to help host.
More of a guest slash, yeah.
That's right.
And he's on the golf course having fun. Not.
Yeah,
He's
right.
working hard, but no,
Yeah,
we just
yeah.
rotate our advisors through, and we have strategic partners. I might as well just mention that now. So for next week, we have, next month, we're going to have Mike Kateri. So Mike Kateri, we've had him on before, but he is our Medicare specialist. Talk about the 2023 Medicare changes, the ACH, Affordable Care Act changes, a lot of updates going on. So he'll be with us next month.
That's
so
great.
Be sure you tune in for that one.
It's good to have connections like that. Yeah, that's important stuff.
Helps a lot of our clients. I don't know. I'd probably say a third of our clients that are retired or at least using him. I mean, he's done a lot of work and providing guidance as best he can as well.
Yeah, and what I love about Mike is that he's an independent agent, so he can write with any carrier, which means that he can write with the carrier that's the best for that particular client.
Exactly right.
So,
Yep. No, he shops the market yearly and doesn't cost you anything. So that's good.
That's right. Yeah.
All right. Well, heck, man, we got a lot going on. So I heard you were out west. So
that is true.
Learning the trade. So we have what's called TNIP, True North Insurance Partners. So we've started that this year, but why don't you get us up and our clients all up to date on sort of the latest? You're our annuity insurance guy, so let's hit it.
Yeah, so I just went out west to Scottsdale, Arizona, my first time. Nice. A group called Annexus is who I went out to hear. That's who put on the conference, and Annexus actually manages strategies for 4 different insurance carriers, their products. And what they do is they go out and they partner with Goldman Sachs and Merrill Lynch and PIMCO, Barclays, some of the big players in the game to create indices, and they use those indices within the annuity strategies. And these guys they're doing some great work. They've been very, very innovative over the years, and a lot of the annuity market is catching up to them.
Yeah, no, that's good. I mean, in the old days, my New York Life years, obviously I sold annuities, but the point is this. So I think it's becoming more in vogue because the products have changed a lot and gotten more efficient and better. So would you say it's helping our more retired / older clients, and there's a niche for that in your experience?
Oh, sure. Yeah, absolutely. And I totally agree. There was a time where you would the only option you had was to annuitize the annuity, right? Which basically means you take this lump sum of money, you hand it to the insurance company. It's no longer yours, and then they just produce an income for you. And that's no longer the case. Now you're actually holding on to that lump sum of money. It's still part of your net worth, and then you produce an income through what's called a rider. And yes, as a result, they have been very helpful for a lot of clients, because what it does is, first of all, it's a much safer investment. So we use Riskalyze, and when you use Riskalyze, you have your more aggressive investments might be an 80 or a 70
on the score, 1 to 100. Right?
Exactly. But annuities, the fixed index type anyway, they're a 1. So you add that to a portfolio, it brings the risk level down.
Right.
But the other major thing it does is it produces an income.
Beautiful.
Yeah. So
clients like income. So
yeah. So it's a way to diversify your income stream. You now have Social Security. Maybe you have a little bit of a pension. Most likely you don't.
Yeah.
But you're also producing income from your investments. And so the annuity also provides an income stream. And in the annuities that I use, they actually have the potential to grow during the income years.
Yeah.
So that income
win-win.
stream, hopefully is keeping pace with, if not beating inflation.
Right.
That's the goal.
Awesome. I'm glad you're out there representing True North Insurance Partners. So,
yes,
that's another feather to the cap we'll add. So, we'll take care of our clients as best we can. With that when necessary. So that's
sounds
great.
good. Yeah, it's been a blast.
No, that's good.
And you took a recent trip as well.
Oh boy, it's my bucket list. All right, real quickly. Sorry, folks, but I did my Bristol night race. So. The crew, there's like 12 of us, but this time only 4 of us can make it. So 4 guys went down to Bristol, Tennessee over the weekend for the NASCAR night race. There's a truck race, Xfinity race, and then the NASCAR race. So we hit all that up. It was great. Awesome track. One of the best venues. So as Dale Jr. says, it's Bristol, baby. But anyway, it's a good time. So it was fun.
Yeah,
but
that's
cool.
good. That's good.
Appreciate it.
Your trip was a little less businessy than mine. I did get to climb a mountain while I was there.
Camelback?
That's
Nice.
correct. Yeah.
My aunt lives there. It's a great
is
place.
that right?
Oh,
okay. Yeah, I had a great time. It was a little hot that day, but enjoyed it.
Over 100, right? When you were there?
It was close. It was just under, maybe 95, which was funny because all the locals said, "Hey, you picked a great day to go. It's a little cooler today." I'm glad they feel that way. It didn't feel that way to me.
I know, dude. I'm sure you had your backpack with plenty of water.
Oh,
right?
yeah. I went through plenty of water.
Good man.
Yep.
All right. Well, let's sort of get into it. Now, being the Fed day, what have you, just timing happens to work out great. We have a lot to cover. We'll do charts at the end, tips of the month, obviously, but maybe we'll just sort of get into let's talk about what the Fed did. So the Fed raised rates, okay? It was 75 bips, 75 basis
pretty
points.
Expected.
Yeah, pretty expected. And I guess going into, the last 2 meetings for the Fed, so there's going to be one on November 2nd, and then the final one for the year will be on December 14th. And, I think Andy and I spoke last month, but you and I, we can talk briefly. They're going to raise rates again, okay? Yeah. So unfortunately, November 2nd, they'll raise rates. What are we thinking? 50, 75?
I'm going to go with 50 in November.
Yeah. Me too.
Yeah.
50.
Okay.
So I'm going to go with 50. I think they may be able to lay off the accelerator a little bit.
Yeah.
So I think it's 50 as well. And then in December, what'd you call
I'm
for
thinking
December?
they're going to pause.
All right.
Yeah.
So let's hope, because last month we talked about, I hope it's all about the language. Either they pause or assist, a 25-er.
Okay, sure.
And then the language is, if the language is good and they do a pause or 25 and a pause or 25 and the language is good, Santa Claus rally.
Yeah, okay,
so
that would be nice.
That's what we're hoping for here. So, the strategics, I know you did some rebalancing, Andy as well. Yep. I was using more of the cash, putting some stuff away there, trying to get a higher yield. Until we can redeploy that. But so it's all strategies going on, but that's sort of what we're, anticipate between now and the end of the year. So a lot more action from all of us, all your planners here at True North over the next few months.
Sure. So, and certainly it's, no guarantee.
No.
We would love to see a market rally.
Yeah.
Another interesting thing about this year is it's midterms.
Yes.
And historically, the market has not done great during midterms. It's, the market has gone down up until about November.
Right.
And then the rally begins. So we have a couple things that hopefully are working in our favor.
We'll see.
We're getting tired of having bad news for clients.
I know. I'm sorry. All year long, but we keep it real. We don't sugarcoat anything.
That's right. Yeah.
So again, with that, let's talk about the midterms briefly. Again, we are anticipating the House and Senate goes Republican. If that's the case, we got gridlock. Markets love gridlock, so that will help part of that year-end rally stuff as well. So a lot going on. Be sure you get out there, do your part. And we'll go from there. So, market's still volatile. Let's just maybe get into the quantitative tightening. So, quantitative tightening, the Fed, along with the roll off, they were doing like $47.5 billion per month for the last few months. Now it jumps up to $95 billion in the month of September.
Wow.
So basically, it's just the bonds. They buy bonds. Okay, it's quantitative easing when they buy it. The easing, quantitative tightening is the opposite when they let it either roll off or don't just let it expire or what have you. They don't buy any more bonds. So we'll see if they can. Their goal is to try to do that and reduce the amount of the $9 trillion that they have. On the balance sheet for the Fed to try to reduce it by like $2.5 trillion over the next couple of years to bring that in. And so that's all quantitative tightening. But when you raising interest rates plus quantitative tightening, the double whammy. So we'll see. That's why we've had in the past soft landing. No, it's a crash. So we'll have that picture for you too. So that's why this bear market ultimately will lead into a recession. It's just, okay, what type? I've always said before, how long, how deep?
Sure.
So hopefully it shouldn't be deep. How long? Hopefully it's not too long.
Yeah.
So I'm on that optimistic side.
Sure.
I think we're...
Yeah. I'm optimistic as well. Yeah. And the reality is, we all understand, we have the perspective, the long-term perspective that eventually the market will recover. At least historically, it always has.
Yes.
And so we just kind of hang tight during these times, and we'll see brighter days eventually for the market.
And with that, historically seeing the market bottoms typically 4 months before the end of the recession. So that's historically how it has rolled. So
that's right.
We're getting closer. One of the titles was the other foot hasn't landed yet. So one has, but the other one still not yet. So we're getting closer. Baseball analogy. Okay, we're rounding second, rounding third. Let's call it maybe sliding into third base, getting ready to go for home. So I think we're sliding into third base right about this time period. So you have to get through a few more rate hikes here, and market's adjusting. So other things too with the Fed, the 2-year Treasury. So the 2-year Treasury, it's topped. This is hot off the press. Right before we came in, I checked. 4.11%. So the 2-year Treasury yield is now 4.11% as of the time of before we came in here.
That's different.
That's the first time it's gone that high since October 2004.
That's unbelievable.
Boom. So that just puts things in perspective. Yeah. And with that said, just a few other stats. So I was on a call, part of our research partners that we use, Day Hagen, NDR, Ned Davis Research, Hedge Eye, some others, but on a Day Hagen call, they mentioned here, remember Tina?
Yeah.
It's not my friend's girlfriend's name. No, it's just Tina. There is no alternative.
That's right.
Okay. So equities, everybody loaded in equities. That was great for 2 years, but okay. Now there is another alternative.
Yeah.
And it's U.S. Treasuries.
Yeah.
So U.S. Treasuries, because the Fed's finally raising rates, and the S&P dividend yield now is 1.69%. 1.69 used to be a lot higher. It's come down. Okay, so that's part one. Part two, the 3-month U.S. Treasury is about 1.69 and climbing and rising. Oh, I'm sorry, scratch that. It's 3.37. So it's 3.37 and rising. That's the 3-month. The 1 year is over 4. It's 4.05 and rising. And the 2-year U.S. Treasury is 4.11 and rising. Mm-hmm. So all those are greater than 1.69.
Sure.
So that's why there is another alternative to Tina.
Yeah. For years now, we've been using bonds to provide stability, but we haven't really received income from them. Right. So it's nice to finally have a chance to put them in a portfolio and actually see a little bit of income as a result.
Yep. So that's everything balances out and goes through the turn. So, risk ranges, just to keep things sort of real as well. So risk ranges, this is today's risk range for the S&P. It could be down to 3770. So I think coming in is around 38, 33 on the S&P.
Yeah.
So 3770, we could see that today. That's the low end. Or the high today is 39.99. Go figure. Those are the risk ranges. again, provided today, again, from Hedgeye. So that's my daily. I have a couple daily calls I'm on and things, and just to keep things in perspective, how volatile things are.
Yeah, right. I think we saw the top of that and the bottom of that right before, before 2 p.m. when the Feds
saw that line.
Yeah, and then right afterwards, whoop,
we all gathered in the hall with Andy and all. We're like, what's going on? It's like, man. Yeah. So,
right.
No, I hear you. So those are just some stats, things that I wanted to talk about. Other things too is, mortgages and, rates are going higher. Okay, great. So things are slowing. That's what the Fed wants. They want to slow things down. But then rent relief. Okay, rent relief is not here yet. So this is just an article. This is coming from, who puts this out? It's called apartmentlist.com. So it's just a website, I guess, in Columbus. In August, rents were up 11.5% higher than they were a year ago. So year over year, up 11.5% for August only. And then according to this apartment list, which ranks Columbus, now it's 35th in rent growth among the nation's 100 largest in metro areas. So Columbus is now ranked 35th highest in rent growth out of the 100 largest in metro across the country. Boom. Wow. Holy cow. Yeah. So one last stat here. According to the listing website, the median Columbus area rent is now $1,086 a month for a one-bedroom apartment and $1,308 for a two-bedroom apartment in Columbus, Ohio. Rents are up more than 25% since the start of the pandemic in March of 2020. So a little over 2 years, rents are up over 25%. Yeah. So just want to throw that out. And the rent is one of the last things that makes up a third of the CPI index, Consumer Price Index. Mm-hmm. So when it makes up a third, and it's the last to turn, we're going to have this high elevated rent things for another, 9, 12 months. Sure. It's a lagging indicator.
Sure.
So,
well, and here in Columbus, there could be so much demand moving forward with Intel coming in and with the growth of the city that we may continue to see this.
Yes.
It's hard to say, but I wouldn't be surprised.
Amen. Which is not good, but no, I know. I agree with you on that.
Yeah. Unless you own. If you own the house, then it could be a good thing. Building equity.
Yeah. So again, just bouncing around a little bit, but just keeping things, last Friday was crazy. That was options expiration. So about 3.2 trillion in options expired. So we had a spike in the trading volume, as we always do, and I tracked that. But interesting, like examples, Adobe, FedEx, reeling in their guidance. Companies are going down. It's just, Verizon Express now at 52-week lows. It's just crazy to see this, but this is what's coming. So, the old mantra was, hey, it's not really, we have inflation, but it's really profit and revenue growth is sort of what the new thing to look out for. So as profits and revenue growth declines, heading into a quad 4, okay, quads 1, 2, 3, 4. So we're in a quad 4. It's going to be challenging as Fed raises rates, as quantitative tightening. So again, we don't want to paint it all gloom and doom, but we do keep it real. And one other thing, the GDP nowcast, so the Federal Reserve Bank of Atlanta, starting out a month ago, it was 2.5% third quarter GDP growth, 2.5, a month ago. September 9th, it was 1.3, went down. On September 15th, it was 0.5. And as of 9/20, it's now 0.3.
Okay.
So 0.3 is now the GDP growth rate for the third quarter of 2022. Okay. So you can see it, not good. And then I heard briefly on the way out from the office here, the forecast for GDP growth for the entire year now is 0.2. 2022.
Okay.
That's what the Fed just announced. So
interesting.
It's going to be, I think it's going to be high. I think it's going to be flat to negative for the year.
Okay, sure.
So, it's going to be challenging. So I just wanted to, again, keep things as is. And it is what it is.
It's helpful.
Let's see. So tips of the month here. We have a couple things. We have schooling, back to school, all that. So October 1st is the FAFSA, F-A-F-S-A, FAFSA. Yep. So FAFSA, it's good for children. Apply. Sure. So, those senior in high school, apply for it. You want to, and then obviously if you're in college, you keep on applying for it. Apply for it no matter what, because it's free money. I mean, if you can get it, you can get it. Yeah. And then so that's just something to keep an eye out. So we always like to remind folks, for those who are in that realm or space with kids, October 1st is the window for the FAFSA opening. Yep. So please apply for the federal student loan grants and things of that nature. Yeah, definitely. So what's been going down in the last 2 years? Yeah. What's been going down?
The market?
Well, besides the market.
Besides the market, what's been going down? Is this a riddle that I'm supposed to solve?
That's a riddle. Yes. Boom. Yeah. Life expectancy. It's the E&E show.
Yeah, right. So the Eric and Eric show. Yeah.
Yep. So life expectancy. Again, this is coming from the demography. Neil Howe from Hedgeye, fabulous guy. I track a lot of his stuff. So with life expectancy, it's sort of sad, but in 2019, life expectancy combined for male-female combined was 78 years, 10 months in 2019. Okay. 2020, it dropped to 77 years even. 2021, it dropped to 76 years and 1 month. Okay. So the last time that it has been this low, 76 years and 1 month, was back in 1996. It's 25 years ago. And here's just a little chart for you all to see this. So again, life expectancy, you can just sort of see it go up, but then reverse course. Yeah. It's like, it's not good, but we can sort of peg it as to why. So on the next page here, life expectancies beginning 1900 through 2021, certain things, the Spanish flu. That Spanish flu took off 11.8 years.
Interesting.
Yeah. When you had the Great Depression, 1933 to 36, it took off 4.8 years. The World War II, from 42 to 43, took off 2.9 years. And here we go, it's COVID. So COVID took off 2.7 years. Yeah. So it's just a nice to frame it out. So we will come back up again. But right now, we're still paying that price for.
Wait, hey, there's a silver lining in all negative news, right? Yes. Because Social Security is suffering.
Yeah, you're right.
because life expectancy has continued to go up. Right. It makes it tough on Social Security. Yes. But if that reduces, I guess
it's extended the lifeline.
That's right. Yeah. There we go.
So that's good man. No, I hear you. So awesome. Well, I think we covered a lot. I know there's still, Putin came out today talking about mobilization, more troops. So heading into the Ukraine's going to be with us for a while longer. The UN meeting was today, which is a joke, but it sort of is what it is. I think maybe we'll sort of get into the charts, if you don't mind.
Sure. Yeah. That's fine.
Anything else?
Well, I might just mention, there's also silver lining. We've talked a lot about the market going down. Yeah. But for us as advisors, we feel like there's opportunity there, right? As we've talked about rebalancing when you're selling the assets that have stayed a little more stable, and you're buying the assets that are on sale. So there's an opportunity for us there. Also, in terms of financial planning, there are some opportunities. So if you have an IRA that you have been considering converting into a Roth IRA. Here's what you're doing. You're taking an IRA that perhaps is down 20%. You're converting that over. And then once it's in the Roth, it's now able to grow. Hopefully once it recovers, it's going to grow back, and that'll be tax-free money. Bing. So that is a significant advantage.
And didn't you have some clients recently come in and do Roth contributions
just today.
Today, okay.
Just today, I was selling assets in it's an individual account, assets that are down, so they're going to be able to take their short-term capital gains, long-term capital gains this tax year,
take the losses,
move that money over to the Roth IRA, and then same concept. Now it's over there. They're able to squeeze more in, and hopefully as it grows back, it'll be
spring effect. Right?
Yeah, it'll be tax-free growth.
Beautiful.
So these are great opportunities. Yeah,
good. I'm glad you mentioned that. That's awesome. All righty. Well, let's again. You've all seen these, but these are great charts. Always like to run through them. Nathan, our producer, will do a great job in just focusing in on these charts. So we're going to sort of plow through it here. So stock market volatility, the VIX, you've all seen this. The average VIX is 18.5. As of 20th, it's 27. And it's remember folks, under 20, green lights. 20 to 30, the chop bucket. Over 30, the F bucket. We'll leave it at that. So we're approaching the F bucket. Yeah. So we're going to have a little more volatility. We'll probably trickle into that F bucket between now and end of the year, but it will be short-lived, and then go from there. But I always like to keep that fresh and in front. Remember, we talked about the pullbacks. S&P 500 has pullbacks on average of 4.6 times per year of a 5% pullback. Right now, we've had 9 of those. And okay, relatively speaking, last year we only had 1. So just to keep things in perspective, and yes, we're going to have more than 9 between now and end of the year. Stock market valuations. Valuations, again, 1 year ago, you can see in red at the little X, and then where we are today. So the nice thing is they're all coming in, which is good. So as the market does come down, things are going to get more fairly valuated, and then eventually we'll have that springboard effect that we've been talking about. Yeah. So that's the good news of that. S&P earnings per share. So this, I've heard a few companies last month, but really this past week and this week as well so far, companies are finally reeling it in, like FedEx, Adobe. Other ones are being forthright and saying, hey, we're not going to really hit our guidance or this or that. So that's good in the long term. That's all part of the bottoming process.
Sure.
So as we get there, remember, we bottomed 4 months before, so hopefully we get there sooner rather than later. But this earnings has to come down. This 220 rate, basically, it will be coming down. So you'll see a pike there starting to curl over already. So that's one thing. Growth rate for the S&P earnings growth rate, you've already seen it come down dramatically. Okay, that's good. It needs to come down even more. So that's all part of it. Interest rates, the 2-year tenure. Remember the inversion? I track it all daily on my charts. So everything's inverted now. So the 3-month tenure was the last man standing, meaning there's always been a recession when the 3-month is greater than the 10-year. And that broke a couple weeks ago. And all the other ones are already inverted, but that was the one that is 100% spot on, and it broke. So on this chart, you'll see the gappage there, and then with the rate raise today, this is already outdated. You get spreads going higher because remember the 2 years, not 3.96, it's 4.11 and going higher. The steepness of the yield curve, again, the inversion's 0.39. That inversion, this gappage will go even deeper. So again, the inversion. Mortgage rates. See, the Fed wants to slow down spending, wages, all that. They were trying to that will help bring down the inflation. Sure. So that's why mortgage rates spiked. So the average since 1990 is 5.9. Well, it's crossed over 6% now. So mortgage rates were, here we are. Yep. And it's called rate of change. The rate of change has been so fast, it's just grinded to a halt. Yeah. Again, the mortgage refis and the apps just fell out of bed. There's nothing there. So Fed funds rate, this is sort of, it really doesn't matter. The dot plots, all that, is what it is, but it's going higher. So this is their thing. But it's neat to see visually relative to the other years that we've had lower bound and cycle peaks and all that. So again, sort of neat to see. Economic growth. Remember, we talked about this first quarter. Q1 was minus 1.6%. Q2 is minus 0.6. Q3, again, they brought it down to 0.3, and it could be lower. We'll see. So, it's tough out there. Yeah. Wage growth. The Fed wants to see that wage growth. It's spiked up, all that free money, prop, all that stuff. Now it's coming back down. They want to see that. So that's intentionally why they're doing all this. So, yes, they're not going to have a soft landing, and this is all part of their MO. CPI, okay, 8.3. So the inflation has peaked. Yes, certain parts of it are still moving up and down, but inflation has peaked, and you can see it right there. But the Fed focused on the PCE inflation. That's just their official. They like to focus on this one, and it's really the core 4.6. They want to get that down to 2. So that's their mantra, is to get it to 2 or around 2. So basically, CPI is going to be elevated and sticky. Okay, all this year you're going to see prints coming out all in the 8, 7. I think I won't see 6% till next year, first quarter next year. Okay. So that's based on, again, Hedgeye and things of that nature, but one of our research partners. So it's going to be sticky, elevated, but it has peaked. Stock market bull bears. This is always interesting. So yes, we're in the bear market. We've said that. It's just, okay, how long, how deep? Okay. Sure. So we're already there. It's just how long, how deep. Again, good news is there's more bull markets than bears.
That's right.
So that's that. A couple more charts. Currencies. So I follow currencies dramatically. I trace it. It's incredible. The dollar is up, I think now after today's move, it's over 15%. So if we just put everything in dollars, we're up 15%. Right. Hello. But the upside is the dollar, you can see it over the past 24 months, gone up. It's now a 111 as of today when I walked in. So dollars crossed the 111 mark, straight up. All the other foreign currencies are down. So everyone's buying safety. Yeah. Okay, so that's the dollar. Strong dollar. Again, the Fed's okay with that, having a strong dollar that helps lessen the inflationary effect. So they don't, so strong dollar, quantitative tightening, and then Fed raising rates is just what a mix of that going on there. Bitcoin and dollar, I always like to show the Bitcoin because, we have our clients, I want Bitcoin. We've been saying, Andy, you and I forever, no. And thank God, because at the beginning of the year, it was over 60,000. And right now it's 18, okay? So you lost your shirt in Bitcoin. It's not regulated yet. And once it is, then we will look into it. Yeah. Dollar straight up, opposite. So it's over 111 right now. Savings rate. This is what's concerning. Okay, historical average is 6.8% savings rate. This is all the past 2 years of free money, all the quantitative, 35% savings rate, straight down. Now we're down to 5. People are borrowing, debt is going up. It's not good. So you're going to have a lot of things rolling over, and it's going to be hard. So security, boom. Good news, like you said, when you have higher inflation, you get higher COLAs, cost of living adjustments.
Yeah, that's true.
So the estimate's 8.8% as of right now. We'll see. It's all based on August, and they can change. But the official one that comes out in October is when they officially stamp it. So I think it's going to be the 8-ish range based on it's sticky and elevated. So that's that. So remember, folks, we appreciate you. And then next month, we will have Mike Terry from a Medicare specialist coming out, talking about the changes, the ACH and all that. A lot going on there. But please reach out to Andy, Russ, Eric, Biddle, myself. We're here, Stacy as well. True North, we are growing, and we appreciate you. Again, do our best, and anytime, let us know.
And thanks for tuning into the Eric and Eric Show.
Amen. Keep the faith. Thanks.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Special thanks to our producer Nathan, as we will be producing these episodes on a monthly basis. Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to the results that may be obtained from this. Investing involves risk, including loss of principal, and no strategy assures success or protects against loss.